here we have the euro. This is a 4-hour time frame. It doesn't need to be the euro. It doesn't need to be the 4-hour time frame. So I'll change to the yen, for example.
Okay.
So here we have the yen. This is trading view, by the way. For example, instead of the 4-hour time frame, so maybe we want to look at the 15-minute chart, just to pick an example, right? So when loading, notice that we have been given this green UFO and these red UFOs up there.
Mm-hmm.
So, but to be honest, in this particular case, and this is just a coincidence, I will look at other markets later and you will see it's not always like that. But in this case, it's actually pretty nice. Because if you were to plan on a trade to go long at this price with a stop below the UFO, and therefore that vertical distance is your risk. And because the buy orders you would expect from those buy orders to make the prices to go higher, 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 you were then to set your target where the red UFO is, which is where the sell orders are. So you buy where you buy where the buy orders are, you sell where the sell orders are. So then you will be risking that vertical amount in exchange to make that vertical amount, which I don't know, visually speaking looks like maybe a 4 or 5 to 1, which is not always like that, to be honest. I mean, there are many cases. Let's go back to the euro, for example, on the same 15-minute time frame. Markets are dynamic, so things change all the time. So in this case, you can see, and here, by the way, this is a great example. So first of all, you can see how price went to the red, and from there it went to the green. So this could have been a trade that you have taken. But if you have taken this trade at this price point with a stop here, and you have taken profits here, it's more like a 1-to-1. Yeah. So from a risk management point of view, I'm not in love, even though the trade worked, as you can see. But again, not impressed, right? And by the way, then you can also, I'm appreciative of this example because it allows me to show a few things. So notice as well how this green UFO has been traded through. Price went beyond. Yeah. Okay, and that is because all the buy orders that were expected, well, they were not there. So again, it's a statistical presentation of where we think the orders are, but it's not always the case. Or maybe it was the case, but the amount of unfilled orders was not significant enough to turn the price. So how do we make? I'm extending a little bit my answer, but how do we make our methodology better and a bit more robust? Well, apart from just trading the UFOs, we look at other tools. The one below here is called the AutoClimate. And the AutoClimate here tells us that we are, with the red dot, the AutoClimate is telling you that we are in a down climate. So since that candle, we have a statistical advantage by going short and not going long. And some of the things that we teach in our courses is that in the down climate, sell unfilled orders tend to be added and buy unfilled orders tend to be removed. So, again, this is a great example because it shows you why this trade worked very well, why the climate was down and the sell orders were here. It shows you also why taking a profit where the green is makes sense, because notice that even though the green was traded through, in the end, price stayed there stagnant. So even if ultimately price may end up going lower, it's not like it's going to go straight down continuously. It's going to have to react to the buy orders. So very nice place where you take profits. But the lesson here is that in a down climate, I would never go long. I would only go short. Kind of like if you were to be a trend trader, you would not fight a trend.
Yeah.
And if you were to be a counter trend trader, then what you would do is that you would look at we have statistics here from our AutoClimate as well. So you would look at statistics that show a very exhausted market with a very lengthy climate, like the one here on the left. Mm-hmm. And here, now you could do the counter trend trade, which is typically less interesting because the impulse followed by the correction. The correction typically is slower moving compared to the impulse. So you typically make more money with the impulse than the correction. So most of our users prefer to trade in the direction of the climate. But again, nothing wrong if you are a counter trend trader. It's just that, just be aware of the climate condition, because I will repeat slowly, in a down climate, sell orders tend to be added. So you get to see more red UFOs show up in the screen little by little. And in an up climate, and in a down climate, the buy on field orders tend to be removed, which is the reason in this case while that UFO failed. Now, this doesn't mean that every trade is going to be a profit like that. Of course, we also get stop outs, but this is a very good example where just a few minutes, I could explain a lot of things here. Hopefully,
Yeah.
I didn't go too fast.
Yeah, this is a very good example. Jose, mind if I ask you some question?
Yes.
Regarding the UFO, right? Because I'm seeing there's some huge circles, some smaller circles. What's the significance of all this?
Yeah.
Circles?
So notice how there is an inner circle and an
Yep.
outer circle, and
Yep.
notice how the inner circle sometimes is small, sometimes is big,
Yeah.
sometimes is centered, sometimes
Okay.
it's not centered like that one.
Yeah.
So what the inner circle represents is where the technology understands that the greatest quantity of unfilled orders is.
Okay.
Whereas the whole zone is an area with high probability for unfilled orders. The inner circle tells you where the greatest quantity of orders should be. So
Concentration.
a trader that is very risk averse could say, look, instead of getting short here with a stop above, right? So instead of getting short at 0.813 and a stop at 0.799, instead of doing that, I'm just gonna go ahead and I'm gonna go short here, a little higher. And now you're entering where the meat of the sell orders is, and you are improving your reward to risk ratio. Now, of course, there is a price to pay for this, which is you may miss the trade. If you look at exactly where this turning point took place, it took place maybe a couple of pips under the circle. So if you were that trader, you miss the trade.
Okay.
But that's the meaning. That is the meaning. And again, like if you were to trade, let's say the 8-minute time frame, for example. So your trading zones are going to be fairly narrow. So from 41 to 45, that's 4 pips. If you were to trade, let's go on extreme daily time frames. Let me adjust the scale. So your zones are going to be wider. So 0.960 to 0.1017. Right, so that is like 57 pips, if I'm not mistaken. So of course, larger time frame, larger UFOs. So then, in a larger time frame, to me, it would make more sense to use the inner circle in the sense that you are saving a greatest amount of pips of risk, while you still make your trade, fairly likely for you to get filled because the zone being larger, so that's less significant. Whereas in let's say a 2-minute time frame, I'm going extreme here. In a 2-minute time frame, your zones are going to be so tiny. So 0.788 to 0.790. So you have 0.2 pips there. So there's nothing to shave really because the bid-ask spread from your broker is going to be larger than that,
Yeah. Oh, so right now the 2 minutes one is basically just like a horizontal line, right? For the inner circle.
Correct.
So it's like very tight.
I mean, the technology is precise enough. It deals with the 5 decimal places, but the reality is that, to trade, you need the bid and the ask price, right? So.
All right.
Yeah.
Amazing.
So so this is applicable to, I don't know, maybe you want to trade, gold ETFs, for example, and maybe you apply this on a 4-hour time frame, So again, this is what you will want to do. Same story. You look at the time frame you trade, you look at your climate. In this case, another great example, to be honest, you can see is a red dot, but it's thin. So whereas those red dots on the left were thick. So thick means confirmed climate, thin means unconfirmed. So you have less statistical advantage there to trade. And so, in my case, when I see that, I pass. So I would not be trading this short. I would wait for the climate to go back to blue. And when the climate goes back to blue and it gets to those green UFOs, let's ride it again, And again, stop in place, but you know where to place the stop. That's another beauty of the UFOs, that you place the stop where there is no more unfilled orders. So if you get stopped out, actually you're okay to be stopped out. I'm not going to say you're happy to be stopped out because we're never happy to be stopped out. But if you know what I mean, you are actually happy to be stopped out because you are stopped out at the right price. Whereas if you were to use, let's say, a volatility stop, like you place a stop, at 30% of the daily ATR, for example, nothing wrong with that technique. But at the same time, it's a little bit of a random number because why 30% of the daily ATR? Why not 15%? Why not 45% of the daily ATR? So in the end, it's a number you pick. And by the way, your ATR is calculated based on 14 candles. Why not to use a 5-day ATR instead of a 14-bar ATR? So, there is a little bit of subjectivity there. Not a big deal because in the end, if you have rules of that sort, you are mechanical, so that's okay. But at the same time, if you can be a bit more precise, that works towards improving your reward to risk ratio. And if you improve your reward to risk ratio, at the end of the month, you are much better, and at the end of the year, it made a massive difference. So that's the philosophy behind the tools.
Jose, can you explain maybe the why there's a difference in the shading and the significance? The shading of the green, for example.
Oh, yeah.
So when the shading is dark, like this one or that one,
Yep.
okay, dark red or dark green, it means highest probability based on the logic of this tool. When the shading is lighter, it means that there are still unfilled orders left, but the probability is probably slightly less. And to be honest, we are being lucky today because I don't need to spend too much time looking for charts because we're having very good examples on the screen, just like picking a random symbol like I did.
Yeah.
Sometimes it's very subtle to explain the shading thing, but today actually it's very simple. And I got two examples here. So you can see this UFO here, which is lighter shaded. And it's because the expectation is that less unfilled orders are left. And the reason why is because you can see that this box starts here. This is where the box starts, if I go all the way to the left.
Yeah.
But notice that even though the box started here, we had a situation where gold came to this price point and bounced. In other words, orders got filled. So if orders got filled, you have less unfilled orders left. And that's why it's less probability. Now, if I zoom in, and again, there is so much more to this. The technology processes a lot of data, but just so you understand the rationale. So how deep that bar went inside the green zone? Well, did it go deep or just like kiss the zone and went away, right? So in other words, again, well, there's more processing behind that, but just think about it from a common sense point of view. How many orders got filled, given the fact that price went there and basically spent no time, didn't go deep? So very, very few orders got filled. So I'm still expecting many unfilled orders left at this price point. And that's why the green UFO still shows on the screen, even though a little bit of a warning sign is that it's lighter color. And the one above here, again, same story. Okay, so if you look at beginning here, again, very easy example. Sometimes it's not so easy, visually speaking, but in this case, yes. And notice here another kiss, right? And then you have beginning, merely touch it, and then beginning of a zone, and then tiny keys, barely touch it. So that tells you that there are orders, but not many were filled. Because if there were orders but they were all filled, then you would see something like that, which is the inverted V thing I was talking about earlier. Right? Yes, there were orders, but they are all filled. You don't have a red UFO at this price point. Okay? So if I was to draw a classical support, this is where my line would be. And yes, you can see how resistance becomes support. So technical analysis, classical technical analysis may make sense. What was resistance became support. You can see it here, right?
Yeah.
At the same time, just for fun, let's rewind. Right? I'm using the bar replay tool available with TradingView. Let's go ahead and using that inverted V, draw a line. Okay, and if you look at what's happening is that this inverted shape, it's kind of coinciding with a green UFO. So I mean, I don't know if that's the UFO that bring the price up, or that was the classical resistance that then became support. Okay, I'm just replaying the market so you can see the UFOs in action, but you can see how I'm not sure if that was exactly where it turned or it was into the UFO. Here we go.
Yeah, it should be that one.
You see? So in this case, you have two forces helping each other. I don't know, I'm just a humble guy. The market is the boss. I don't know if the classical resistance that became support created a starting point or it was the UFO with the unfilled orders. I don't know.
Yeah.
But the fact that two of them were lining up helped the probability of this turning point to have happened. And that was my point earlier. I mean, that was the turning point, and that was my educational point as well.
Yeah. I mean, at the end of the day, for us traders, as long as it works, we don't really care, right?
Exactly.
We just want the things that work. Yeah.
Odds and risk management.
Yep.
And repeat.
Exactly.
That's it.
Exactly. Totally agree with you.
just a bit of a personal experience shared using this AutoUFO. Is that for me, how I feel, because my trading style personally, I do a lot of price action. I trade a lot of key levels, but I find that when I combine it with AutoUFO, so far from my testing, limited testing, is that it gives me additional confluence, definitely, for my entries. And it helps me get rid of noise and makes my decision making easier and faster. Because, for example, if I were to short from the red UFO, right? If I were to short and there happens to be UFO there, it gives me confluence to enter. I will enter. And when I see that my take profit point also happens, there happens to be the green UFO, and the range in between indicated by the red and the green UFO, it gives me more conviction to hold the trade. You know, as you know, because in between you have a lot of noise. There are a lot of levels. If you wanna focus on them, you find a lot, right? But it gives me conviction. It gives me clarity, and I think end of the day, that's very important for a trader.
Yeah, I totally agree. And the fact is that, you know, the moment you understand the concept of trading, the importance of risk management, the importance of profit zones, all of those things, you could use the UFOs the way I just explained, the way you just mentioned as well, which is kind of a different application of what I said, but looking for the same concept. So you have your technique, you have your price action, you have your key price points that you look at, etc. And then with the UFOs, you're using it as an odds enhancer, and also has those extra benefits of, you know, removing the noise, avoiding distraction, in a way also keeping you accountable. So, you know, maybe you just got a loss and you hesitate to take the next trade, but now the UFO tells you, hey, this is the trade. So you have to take it. So, you know, there are multiple benefits there, but also, like, for example, what about breakout traders, right? So look, for example, you may be looking at this pivot high here, you know, and you may be thinking, if price, you know, because we're talking about the red UFO will bring price down, okay? Which I'm not confident because the climate is not confirmed. Okay. So in a case like that, I would be looking for a change of climate and therefore a breakout of the UFO. Now, if that breakout happens because there is a UFO and there is this turning point here, is that breakout likely going to succeed? I would say yes. Why? Because there is nothing to stop the price until we get to the next UFO. So there is profit margin. There is white space on the chart. There is profit margin. So that breakout may not be a fake out. Where there may be other situations. I need to look for another chart. I'll pick randomly, let's say the 1 hour time frame. Let's see what we see there. Okay, perfect example. So, for example, here, many people may be looking at this low, and they may be like, okay, so if gold in the 1 hour time frame breaks this low, I'm shorting as a breakout trade. Well, that's gonna be a breakout. You got 3 UFOs below price. The odds of these to do something like that and then reverse is extremely high. So your breakout is a fake out. So again, you may be using the UFOs for entries, or you may be using them for targets only, which is what I'm doing now. Again, there are many ways on how to trade, to be honest, but in the end, it's all about, you know, having a method, being comfortable with your method, having the method to produce a statistical advantage, then manage the risk, and then repeat.
Yeah, exactly.
And that's it.
Totally agree with you.
So I'd say that this is a pretty good demonstration of how versatile the system is, right? Accommodate to many different types of trading.
Since I'm sharing screen, I'll show one more thing that maybe is useful. And I know we're taking lots of time, but I'll do this quick. I believe it will add value. I'm just gonna pick another currency. Let's go for the pound, for example, just to get a bit of diversity here.
Take your time, man. We're enjoying it.
Oh, me too. Believe me, you know, I'm very passionate about this. So here's the pound in a 1 hour time frame. So look, I can turn on my UFOs, and there is a calibration setting here. Okay. So that calibration setting can be used to make my UFOs more active or more passive. So more active or more passive means more UFOs or less UFOs, and higher probability or lesser probability. Meaning that an aggressive trader, by definition, is a trader who wants to trade more often and is happy to be stalled out to be stopped out a bit more often too. That's an aggressive trader. Whereas a conservative trader is a trader who wants to trade a bit less often because he wants or she wants to be stopped out less often as well. So in that sense, calibration goes from 0 to 1. And if you use a little bit of higher value, okay, typically 0.7, it comes by default with 0.5. So if I make it 0.7, typically, it depends on the markets, okay? But typically, in this case, it didn't change too much, but you can see it's, a little subtle variation on the UFOs, typically a few less. And if you go for a small number, like 0.3, for example, again, not every time from every market is the same all the time, but typically you will have a few more UFOs and slightly in different locations, so they allow you for a few more trades. Now, how do you know what's best? Apart from personal testing and experience, there is the UFO stats that come in here. And I want to kill two birds on one stone here, which is to talk about calibration, but also about stats. Because when I talk about stacks, I will kill another two birds with my initial two birds, which is four birds now. Too many birds. Anyway, take a look. If I turn on show stats, okay, and they will show on the upper right corner. So I need to compress sorry, not that. I need to expand exactly. So you can see calibration. So 58.58. So what that number means is that in this time frame with the pound, with this particular data provider, which is in this case I loaded FXCM. Okay. Of course, with when you load a currency such as the pound or whoever, you can choose other providers. It could be forex.com, it could be Oanda, it could be ICE, which is an aggregated fee of forex across multiple brokers. So I'll use that one, even though ICE is not a broker. And now you got 64%. So market data is relevant. Okay. But putting that on the side, the beauty, first, let me tell you the meaning of that figure. That figure means that 64% of the times, when price goes to the green, it rallies to the red. And when price goes to the red, it drops to the green. Okay. So traveling from green to red or red to green happens 64% of the time in this time frame for this market.
Wow, that's amazing stats, huh?
So
64%.
Yeah, and to some people this is amazing or not, but the point is, and we were using a very important word earlier, which is the word expectation.
Yep.
Okay, so now you know what to expect, and why is this important? Because that brings in confidence. And I'm not saying you're gonna trade a pound because you see 64 and you never traded a pound before and suddenly you are confident. No, confidence takes time to build. Experience leads you to confidence, right? Experience tells you what to do. Confidence allows you to do it. Such an important quote. So it takes a bit of time to develop confidence. But here's what I mean by confidence. Let's say you have been trading the pound for a year. And the pound is your bread and butter, and you know the pound very well. And today suddenly you're like, you know what? I would like to trade the euro yen. But you never traded the euro yen.
Totally different beast.
Totally different animal.
Yeah.
Right? Or not. Let's see. Let's measure. So now you load the euro yen, and now you got 63.33%. So now, first of all, that tells you that in a way that also shows you that our tools are intelligent and they adapt to the markets, more liquid, less liquid, all of that. But beyond the beauty of the technology we've built, putting that on the side, from a trading point of view, from a portfolio management, from a risk point of view, think about this. If, let's say, you were hungry to find more trading opportunities and you're like, I want to add more trades to my trading, and you are used to trade the pound, which makes, has a performance stat of around 64%. And now you see the yen on a similar time frame is 63.33%. Would it make sense for you to add that currency pair to your trading? Yes, it would. Yeah. Whereas maybe, I don't know, I'm just going to go extreme here, USD Mexican peso, 57%. I mean, again, the technology it's powerful and identifies what's relevant, but notice how there is less performance. So now you know what to expect. So that actually helps you to pick the markets you want to trade, right? So it's such an important concept because it allows you to create equivalency when you compare markets. That's another thing that was bothering me very much in OA when I started learning how to trade, where they tell you, head and shoulders, Fibonacci, or whatever, and now you expect it to work the same on McDonald's versus crude oil, right?
Yeah.
So, well, if we look at if we look at U.S. oil, for example, right? So if we look at U.S. oil, so in this time frame, 53% on the 1 hour time frame. Again, this depends on I just use the trading view time frame for oil.
Yeah.
If you change time frame, 15 minutes, for example, that's gonna give you now 54%. If you look at the 4 hour, it's gonna give you 48%. So you can see how certain time frames are more powerful than others, but
Yeah.
definitely it's probably not gonna be the same as McDonald's, which is a totally different name. Actually, funnily enough, it is the same, 47, 95% in this case. But there are cases where, look at that, in the 15-minute time frame, McDonald's is actually 59%. So if you trade the McDonald's CFD, right?
Yeah.
So it could be quite interesting as a trade. And maybe, some of your guys never thought of trading McDonald's CFD, right? I mean, maybe there is an opportunity. So again, the beauty is that with the tool, with this calibration, you can make it more aggressive, more conservative to align it to your trading psychology and trading style. But then those calibration figures, they also help you to understand the nature of the markets that you trade. So if those markets are okay or not to be added as markets in your watch list and your portfolio. Anyway, I thought this could be a relevant point for this conversation.
Yes, definitely. Opens up our eyes, man. I mean, like with this tool is like super flexible, right? It can go across any sort of instruments.
Yeah.
Oil,
Absolutely.
forex, stocks.
Yeah, I mean, some of
Impressive.
our guys, they are some of our people, I call them UFO purists. They just trade the UFOs and that's it. I personally prefer to combine the UFOs with the climate.
With the climate.
So I do a few extra steps. Some people maybe FIB traders and they do something like that. And look at that. There is no confluence on the 23. Don't trade the 23. Actually, none of the FIBs have any UFO in this case.
Yeah.
So if you have FIB trader with McDonald's, no trade. You have less odds. Let's say you are doing it with, I don't know, I'll go back to the euro, just to pick one. And again, just for fun, I'll do 4 hour time frame. So maybe you are looking at all this move and you are looking for a, impulse correction and you're looking for this move to restart. And some Fibonacci guys are looking at the 50% and they're like, yeah, when the euro comes to the 50, it's going to bounce. Well, it may, but I will tell you, there are many more odds that the 61.8% is going to work better because you have the retracement and the UFOs. So by having the two, you have two forces pushing your direction instead of one. That's more odds. May I miss the trade if I was to trade the 50? Yeah, I may. But I'm containing my risk. I'm being more disciplined, more mechanical, more systematic, less thinking, spend less time, all of that. So, yeah.
Awesome. Jose, mind if I ask you a question? Like, what's the max distance like for the auto climate, right? I saw there's a max distance, standard deviation. What does that actually mean?
So what the statistics here represent, those statistics are about quantifying the sustainability for the climate condition. So in this case, we have a climate condition, which is down climate, where from a count point of view, count means duration, how many candles. A normal thing to happen from a duration point of view, you can see here down arrow standard deviation. Okay, so this is a one standard deviation. Okay. So you may want to think about 68+% of the cases. So in a one standard deviation times, so the duration of this climate, statistically speaking, is 5 candles. Now we are facing a situation which is out of normality. This climate has been running for 30 candles.
30.
This is absolutely not normal from a statistical point of view, but it's happening. So look, that you see, that's life. Now, having said that, notice how most of the times it's not the case. Look at the prior climate, look at the prior climate, look at the prior climate. So again, statistics are a fantastic reference, even though sometimes you have abnormalities in the market, and that's why we use stops. But statistics are definitely a relevant, stable reference point where you are not winging it. You are supporting your decision on something solid. Okay, so here from a count point of view, which is duration, 5 is a normal thing to happen. We are in front of a climate which is statistically unsustainable. This thing should reverse sooner than later, based on statistics, based on duration. Max distance is another way to look at sustainability. And to define max distance, I like to think of this concept, which is moving too far, too fast. If something that is supposed to last for 5 candles went too far, too fast in 1 candle, probably is not sustainable anymore, even though typically it lasts 5, but it went too far, too fast, so then it's not sustainable any longer. Is that making sense?
Yeah.
Like you throw a ball against the wall super hard, it's probably going to bounce back very hard as well.
Just like a rubber band, right?
Kind of like a rubber band type of effect, exactly. So now the question is, so what is too far, too fast? So again, we use stats. In this case, that is a 2-standard deviation. Okay, so 2-standard deviation, which, you know, in Lehman terms, that would be around 95% of the cases, rounding figures. So in a 2-standard deviation percent of the cases, a 2-standard deviation of down climate, down arrow because it's red, it's 1.34. The maximum extension of this climate, which was on this candle, which was
1.74.
Yeah, was 1.74. Sorry for so many lines. So this type of a move was classified as too far, too fast.
Okay.
Too far, too fast. And if after too far, too fast, you had a couple of blue dots, then you will be on another serious down climate, you know, and that's sustainable, and it would keep going and going. But because how it happens, statistically speaking, and of course I could be totally wrong, I'm just talking about stats, but because the way on how it happened, we are in a situation where the euro is in a down climate, which is unsustainable based on having moved too far, too fast, and having lasted for too long, moving to the downside based on what's normal, based on the nature of this market as represented by its prior behavior in the past. So I would certainly not want to short because we are late to the party. You know, 30 candles is way more than 5, so way late to the party. I would not want to go long because I don't have a green UFO, but I will not be surprised that, you know, 1 hour after our conversation, we have a green UFO that shows up on the screen right there, because this updates every 4 hours, right? So I wanted to say 4 hours. So once that's the case, we may have a green UFO 4 hours from now, 8 hours from now. Maybe it takes another 3, 4, 5 candles, and every candle is 4 hours. And the moment we have a green UFO, so we are likely going to resume the prior long-term, because, you know, that very long move here on the 4-hour time frame, on a daily or a weekly time frame, it's an up climate, which is supposed to last for 6 weeks, and this is still week number 5. So statistically speaking, we are in for at least another week. You know, but right now in the 4-hour time frame, we are in a corrective mode, which is unsustainable, but we are still correcting. We don't have evidence the corrections have stopped, so it's time to wait if you trade this time frame. So those are the elements that we provide with the technology, which is understanding what is the right side of the market in which to trade, long or short. Is it time to trade or is it time to wait based on sustainability? And if so, and that's the key, with the UFOs, you add precision to entries and exits by using the UFOs by themselves or combined with other techniques to add even more odds. And now you have a trade, you have risk management, you have odds. It takes no time to do this analysis because everything is plotted for you on the screen. You don't need to do anything manually. And then you repeat. And that's the life of a trader.